In this video, I'm going to share with you a strategy which I trade on the US30 on high volume days. So by high volume days, I mean CPI, NFP, and interest rates decisions. All of these, we know in advance what day of the month that they fall on, and we can know to look out for them on these days. But also this strategy applies on unexpected news release days. So I don't know if you've ever noticed on the US30, when the New York session opens, the market might sort of stick within a range and it doesn't really look like it's doing much. And then suddenly, out of nowhere, you see a really long-bodied candle pushing the market in a certain direction, and you see all of this volume entering into the market. At this point, you might have an impulse to FOMO trade because you weren't really seeing anything before and you're scared of missing out now that the market is moving. However, FOMO trading very rarely actually works, and it's a lot better to actually have a clear set of rules and a strategy in place for how to deal with these situations. So the Fibonacci Retracement tool is a really good tool for this situation because you can strategically enter on a retracement rather than just randomly guessing and hoping you're going to get it right. So if you are excited to learn, then give the thumbs up button a little hit before we get started. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.
So this strategy only really uses one indicator, and that is the Fibonacci retracement, as we have up on the screen at the moment. I'm going to show you exactly where to draw it and what to do exactly with it. But first, I just want to talk through a few specifics of this strategy. So first of all, it's effectively a continuation strategy. We're looking for a really big move, which happens typically on a high volume day, typically when a bit of news has just been released and the market is effectively overreacting to it. The temptation when you see a really large move or a really long bodied candle pushing out of an area of consolidation or coming out of a very slow patch is to jump in straight away and to get really reactive and to look for something almost immediately because you're afraid of missing out of that big move. But often what can happen is that the market does actually have quite a dramatic reversal, especially when it has just made a big dramatic move. So entering as you see the market shooting down can be quite dangerous because you would almost have to have too large a stop loss to make it worthwhile. But what you can do is wait for the pullback in the market and then enter at what is called the golden zone. So the golden zone in trading on the Fibonacci is this 0.618 mark. And often what happens is the market will shoot down and then it will come back up to this point and then it will continue. So in the moment, it can be really confusing if you don't understand what's going on and why it's going on and what the market's doing. Often when people don't really understand, they see this long-bodied candle, these long-bodied candles pushing down as a result of some news which has come out. So they have FOMO, they want to get into a sell position. Then they see the market making this really dramatic move up and suddenly they panic. Oh no, is the market actually going up? Did it overreact? Is it retracing now? And then they enter into a buy position and then the market ends up going back down again. So it can be very confusing and overwhelming, and especially if you did jump in and start FOMO trading, it all gets very chaotic and confusing. But if you understand that on these high volume news days, what does tend to happen is that the market will overreact. It will then make a really dramatic pullback, but often it will continue. None of this happens 100% of the time. This is just what is typical and does often happen. This strategy works particularly well on those high news days because often that pullback, as dramatic as it is really just a pullback before a continuation rather than a genuine reversal. It would be a genuine reversal if a new piece of news had come out which counteracted that first piece. But if the market had a piece of news which came out which was genuinely bearish, then the move up is likely to be just a pullback, and there is likely to be a further move down. So I'm going to take the Fibonacci retracement off for now. And what we're going to do is draw it back on again. So on Thinkmarkets, the Fibonacci retracement tool can be found along the side here under Fib retracement. So if you grab the Fib retracement, and what you want to do is you want to drag it from the top of the move down to the very bottom of the move down, and that's in a downtrend. If it's an uptrend and you see a big move up, you would drag it from the bottom to the top. So you're dragging it in the direction of the move. So we're just going to drag it from the top to the bottom here. So what I tend to do in this situation is I actually use a limit order. If that limit order gets triggered and hits stop loss, for example, then me being away from my computer helps me to avoid any kind of FOMO or overtrading. Whereas if you're sitting at your desk in a high volume news day, you may be tempted to overreact to the market. So I actually find that this one works better as a set and forget. However, there are some slight complications that can come from that. And that is that you might miss the entry by a point or so. It may not actually get triggered, or it may end up going to one of these other points, which also does happen. So there are some problems with it, but my philosophy is I would rather miss out on a good trade because there's always going to be another good trade. So I would rather miss out on a good trade than take a loss or to risk over trading, which usually leads to many losses. So that's why I do it that way, but it's also possible to set it as a market execution instead. So what I do is I draw on the Fibonacci retracement when I see the dramatic pullback happen. So it's usually a long body candle in the opposite direction. You can then drag it from the top to the bottom here, and you can see that the Fibonacci retracement draws on the key levels for us effectively. We're looking for this point, 618, 0.618, that's the golden zone, and we're looking for a sell position from this point. What I usually do is I usually set my take profit at the 0 point. It does often go further than that, as it has done in this case, but it doesn't necessarily go that much further every time. And it also depends on the time of day, because you don't want to be holding these overnight, because then it almost dilutes the effectiveness of this strategy. So just to ensure that it has a higher chance of hitting take profit, I will go to the 0 point. So what I do is I set one of these position tools, short position, go from 0.618. On the US30, my standard stop loss is 30 points. So I would set a stop loss of 30 points on this one, and then I would go to the 0 point. And in this case, we have a risk to reward ratio of more than 1 to 10, which is great. That is a really, really good trade. We've got a target of 312 points, which is a lot. And we've only taken on a risk of 30 points. Slight nuances you want to be careful for, and slight little things that you want to look out for, are the fact that sometimes it goes close to this point but doesn't hit it exactly. So if I had set a limit order at this point, it would have actually missed it slightly. So that's why where you put your Fibonacci retracement tool at the top and at the bottom does make a difference. Can you see if you put it at the top of the body here, it does hit 618 exactly, but if you drag it up to the top here, it misses it slightly. So the best thing to do is to go to both, and what you can do is you can draw on the range of both. So I'm going to go to the top of the body and the top of the wick, and I'm going to draw on what that range looks like. And if you want to set a limit order, sometimes it's safer to have it just above, as long as it falls within your maximum stop loss range. So obviously, if this range was too wide and more than 30 points, then this strategy wouldn't really work.
So now you understand the strategy rules. If you like this strategy and you'd like to test it out, the first step is to practice on a demo account or a simulator and do a bit of back testing. The reason for this is strategy rules always sound very straightforward. However, whenever you want to implement a new strategy, there's always a few nuances and things that need a little bit of practice before you go live. In this particular strategy, the little nuances or the things that need a little bit of practice are, first of all, identifying if it is in fact a high volume day. So this will take a little bit of practice, but you want to make sure that it really is a high volume day, because if it's just a regular day, it works slightly differently. So one way that you can do this or practice this is to focus on looking at this strategy on the days that we know are high volume. So CPI, NFP, and interest rates decisions. And then as you get used to this, then you'll start to notice it on other days which are a little bit more unexpected. And the second little nuance is drawing on the Fibonacci retracement on the correct points. So in a downtrend, you would drag it from the top to the bottom of the move. However, the slight nuance is the wick or the body. So it's always best to practice this on a simulator before going live, because it can take a little bit of practice. If you found this video helpful and you want to see more content like this, then make sure to hit the thumbs up button and also subscribe to Think Markets for more videos like this.